Hi, good morning, all of you. I think we are good to
Morning, sir.
start. Morning, Pankaj sir.
Yes, sir. Morning, sir. We can start, sir.
Perfect. Good morning once again. I think we are picking up on our continuing our reading on fixed income. We have already spent considerable time on fixed income. I think 3 sessions. This is the fourth session, and I think we'll have one more session possibly, or other one or two more sessions on fixed income. Tomorrow, definitely, I think we are covering fixed income, and if we are able to complete, good. Otherwise, if there's anything residual, we'll try and move it to the next Saturday as well. Uh, as I said, I think, as you start reading level one, you realize some of the topics are fairly important, right? In terms of weightage and also in terms of the context. Please remember, some of these topics are going to be, covered extensively as you move to level two, level three, right? So these are topics that you would like to carry with you. And again, I think the better you can prepare yourself in level one on some of these topics, I think life becomes relatively easy, right? So I think we'll just keep that in mind while preparing that. So it's not as if you've cleared level one and I think then you're done and dusted with the topic. I think it does stay and carry with you for level two, level three as well. Perfect. That said, I think
So
the
just a
agenda.
request, sir.
Sorry. Yep,
Sir,
I
if you
forgot the
could switch
camera.
on your camera, sir.
I
Yes.
completely forgot. Sorry. Yep, there we go. Okay, perfect. So, as we said, I think we are moving towards the reading today, and today's reading includes, your interest rate risk return, and we'll follow that up by yield-based bond duration and measures. Today, we are going to talk about duration and convexity a lot more, and again, important concepts, duration and convexity, and in particular, you will see a lot of numerical questions coming from duration convexity. The numericals are easy; they're largely formula-based. But more so, I think, sometimes what happens is when I used to read my level one, if a topic stretches for a long period of time because it has a lot of content to be read, sometimes fatigue sets in, right? You feel tired of reading the same topic again and again and again. That is absolutely okay. And if you think that is happening with you because you're reading a lot of fixed income, a lot of financial reporting, because these are large topics, right? A lot of economics, my advice would be just switch, right? So if you're doing fixed income and if you feel bored with fixed income, there's a fatigue setting in, I think I would recommend pick up another topic, read one or two sessions from another topic, come back to fixed income when you are in a state of mind to read fixed income again. That would help in just giving you some cool off time on fixed income and perhaps reading something else, so you can randomly switch between topics. There should not be a lot of technical difficulties in doing that. Once in a while there may be a concept which is related to some other subject, and occasionally you might find a bit of an issue there, but I think that's minor issues. I think you should be able to handle it gradually, but that will help you in preparation. I used to feel a lot of fatigue when I used to read for example ethics. It's a lot of theory, right? So the simple answer that for me was, I'll read one standard of ethics out of, let's say, 22 standards that I have to read across 1A, 1B, 1C, 1D, and so on and so forth. I will read only 1A, and I'll close my ethics books. Then I'll move to something which is more numerical based, and that would mix and match would work for me. So if you think that happens with you, I think give it a try. I think that may help you in your preparations. Perfect. That said, the we'll start off with interest rate risk and return today. Some of the concepts would be leveraged from our prior readings. So if you've missed out on any of those sessions, I think recommendation is, I think, please revisit the videos, and I think complete them before you again try and read this over a period of time. What we are trying to understand is what is duration, what is investment horizon, how do you calculate the return on securities like bond market, right? So what type of returns does a bond will give you, source of returns. Now, when we say source of returns, there are three key elements of any bond market investment. First one is your coupon payments, right? You get timely interest payments or coupon payments in a bond market environment, right? So that is your first source of payment, and you get principal payments on scheduled dates, right? So as we have already talked about, if you have a 3-year bond, you will get interest payments for 3 years if it's an annual bond, and after 3 years, obviously you will be paid a principal payment at maturity date, right? So that becomes your principal payout mechanism. Then there is second element of income that some of us have to understand here, right? It's not explicitly stated. I think let's put it that way. It's not explicit that it would be written to you somewhere that okay, you are getting this. But understand there is another set of income that you typically work with, and that is called as reinvestment income. Right now, what do we mean when we say reinvestment income? You will obviously have, for example, coupons, right? You're going to get coupon payments. And if you're going to get coupon payments, you can reinvest your coupons, right? It's not necessary to just, there is a way you can reinvest your coupons, right? So if I give you some interest, for example, if you have a savings bank account, and if you get some interest on your savings bank account, you can actually invest your interest somewhere else, right? You can use that interest that you got and buy maybe gold, silver, stocks, whatever you want. That's reinvestment. So in fixed income also, all the coupons that you get, all the income that you get by way of coupon payments or interest payments in the in interim period can be reinvested, and that is also a source of your income from reinvestment of coupon payments. And then eventually there's a capital gain or loss when you sell the bond prior to maturity. Always remember the keyword here is prior to maturity, because if you are holding it till maturity, there is no problem, right? If you hold it till maturity, you are obviously getting your principal redemption payments, right? You'll get your principal payment back. But if you're selling it prior to maturity, that is where we are saying you can get some capital gain or loss on the security. So it's always coupon payments, income from a reinvestment of coupon, and your capital gain or loss that we are talking about. Now, this second element is very critical because this reinvestment in fixed income, and that is something we talked about last time also, is assumed to be happening at your YTM, right? So if you ask me what is my return on my reinvestment, we assume to be reinvested. I think rather than happening word, let's just say assumed to be reinvested at your YTM, which means if your bond is going to give you a 8% return, a yield to maturity of 8%, we are assuming that your coupons will be reinvested back at the same YTM. That is a very big assumption in fixed income. This is something we were talking last time as well. Okay, so always remember this fact that the assumption is you're going to reinvest all your money back at the YTM. It may not hold true practically, but that is what fixed income works upon. And that is the only reason why you will be able to prove the mathematics related to fixed income. So let's talk about this. An investor purchases a new 10-year 6.2% annual coupon priced at $100 and holds it to maturity. So you're trying to hold the bond till maturity. The coupon and principal payments, or the return consists of the coupon and principal payments, and along with this reinvestment income, that is something that is obviously that is going to come as part of this investment, and any capital gain or loss as part of your investment in this bond. So how do we calculate all this? That what is the amount of money that I'm going to make in this category? Let's first talk about how much coupons will you make on this. So we said this is a 6.2% annual coupon priced at $100 par, which means the face value is $100 and the bond is also priced, right, at $100 par. So you will get 6.2% of $100, that is your coupon. And this is a 10-year bond, right? So this number multiplied by 10, this is your coupon. Along with that, at maturity, you are going to get $100 of principal payment or par value payment. So in total, you are looking at $62 of coupon and $100 of principal payment, which means you are going to get $162 here. Now, how much is your reinvestment income? How much is the reinvestment income that you're going to get if you're going to do this reinvestment? Simple way to calculate reinvestment income. Let's do it here. For reinvestment income, first, how much money are you getting and how much are you going to reinvest? Now, think about this. Every time you get $6.2, that $6.2 is sort of a SIP amount, right? Every year you are going to get $6.2 or you're going to invest $6.2. So think simply saying, I will say PMT is $6.2 on my calculator, which means every year I'm going to invest $6.2. For how many years I'm going to do this? This is something I'm going to do for 10 years. N is equal to 10. At what rate am I going to invest? As I said, your bond is priced at $100, which means the bond is trading at $100 and par value is also 100. And whenever we have this, where par value is equal to the present value or face value is equal to present value, we say the bond YTM is equal to the coupon rate. This is something we proved last time around when we said, if your YTM is equal to your coupon rate, your bond will trade at par value, no discount, no premium. So YTM is also equal to 6.2%. So I'm going to put 6.2% here as well. And remember, when you're going to put it in your calculators, you're not going to put a percentage sign. You're simply going to put a 6.2. The calculator will automatically factor in the percentage number here for all of us. So that is 6.2 I by Y. And then there are two more numbers left on your calculator, PV and FV. Perfect. Now for us, we are showing PV is 0 because I'm reinvesting. PV is 0 if you're reinvesting. You have nothing today in your hand. And I'm trying to calculate what is my future value if I do these reinvestments. So this future value is something that we are trying to calculate. If you put this in your calculator, I don't have my calculator readily available. Let me just quickly do it on an Excel, or rather I have the website, right? Let me just open up the PA2 plus website for you quickly. And let me solve it on the BA2 plus website. If you have your calculators readily available, you can do that. Yep. So the BA2 plus is here for us. Perfect. So let us just do this. Let's say my PMT number is 6.2. I just have to reduce the zoom on this page. Yeah, perfect. I think this will make a better reading. So 6.2 on my PMT, right? That is what my payments are. Then another 6.2 on my I by Y. That is my YTM. Payment, YTM is equal to IRR in this case, obviously. And then I have a 0 on my present value. And I have a 10 on my N. This will help me compute my future value, which is 82.49. This 82.49 means I'm going to get an investment income of 82.49. The $62 that I invest over 10 years will translate to $82.49 over a long period of time. So my reinvestment income comes at $82.49. And this $82.49 helps me understand, okay, there is a reinvestment element that I'm trying to work here with. So what is your total income from this? Subtract $62 because that is what your investment was, right? And effectively, because of this, what you have made as an additional income is 20.49. So your total 62 will convert to 82, and the additional 20.49 that you are going to get is your reinvestment income in this category. So that becomes the way to calculate your reinvestment income. It's nothing but simple compound interest, right? If you think this is difficult to understand, how did 62 become 82? It's a simple compound interest calculation, right? So if you want to do it through a standard compound interest mathematics, you can still prove this, that $62 will convert to $82.49 if I just apply compound interest mathematics. And then proving the fact that all the investments will be made at YTM. So all reinvestments will be at the YTM rate, right? There is no other rate that we are going to invest our money at. This is a fundamental building block of fixed income. If you miss out on this block, I think there is conceptually always an issue for you on fixed income. You'll always struggle to prove some relationships on fixed income as a concept. So, which is why I think we are putting emphasis on this point, that this is something that you should be really, really clear, that all the reinvestments happen at the YTM, and the reinvestment income of $20 is nothing but a concept of compound interest playing out, right? So if I have to again prove it for you using simple mathematics and ignoring, let's say, all the calculator stuff here, because calculator is, just you just put in numbers and you get a answer on it. The simple way to look at this is, see, if I say you are going to make a 10-year reinvestment, perfect. This is my 10-year reinvestment for all of you. And if I'm going to say, how much are you going to reinvest? I'm going to say I'm going to reinvest $6.2 every year. Perfect. This is your reinvestment coupons. Every year you get $6.2. And if this is the reinvestment, what is my reinvestment rate? At what rate am I going to reinvest? So I'm going to simply say I'm going to reinvest at 6.2%, because the simple rule in fixed income is reinvestment rate is always equal to the YTM. And if you are not doing that, you will never be able to prove the relationship or get the numbers right. So how much will my payments convert to? Investment value. Perfect. So if I'm going to say investment value that I'm looking at, my investment value will typically be $6.2. This should be invested 1 plus R, right? Compound interest, amount into 1 plus R, raised to the power N. How many years will this be invested for? So this is going to be invested for 10 years, right? Because you're going to get, or rather, let's say for the remaining 9 odd years, you're going to just keep doing this investment time and again, right? So you're going to simply say this investment is going to be happening for the next 9 years. This investment for 9 years, because you're going to be paid after 1 year, which means you are left with 9 years of investment. Similarly, this investment will happen for 8 years. You will be paid after 2 years, and you will have 8 years to invest. This will be 7 years to invest, 6 years to invest. And accordingly, the money keeps increasing. Last payment that you get will be given to you on the 10th year ending. You will have no time to invest. You will get the money and the bond will retire. So there's no additional time to invest, which is why this amount doesn't go anywhere. This amount remains at $6.2, while all other amounts grow by certain number. And the total of all this is something that we calculated is 82.49 versus $62. And this is, I think, the simple proof of the pudding that reinvestment income is nothing but a difference of these two numbers for us, $20.49. So if you ever get confused in fixed income, how is the reinvestment income coming? It is nothing but every time I give you $6.2, you reinvest. And after reinvesting, what do? You just reinvest it using a compound interest formula. At what rate? At the rate is YTM. That is the implicit assumption. You can, in reality, invest this $6.2 at a higher rate. No one stops you from doing this, that you can invest your money at a higher rate. Obviously, your investment income will be higher, but fixed income works on the concept that everything will happen at the YTM. Perfect. So this bond, therefore, I think now if I go back to the solution that we have, this bond therefore gives you $162 of payments, and around with $162 you get a $82.549 future value, from which if you subtract $62 you get a $20.49 of coupon or reinvestment income. And this is where I think we say, okay, a bond has three sources of income: one, coupon and principal payment; second, reinvestment income; and obviously the third one is if you sell the bond prior to maturity, then you get additional income around it. So how do we calculate the return across 10 years? The return calculations, you got 62 plus you got 100 plus you got 20. How much did you invest? You invested $100. So your return parameter was 1.8249. However, please remember, this is 10-year return and we want an annual return. So for annual return, we are doing a compounded annual growth rate calculation. We are simply saying whatever the return is raised to the power 1 by n minus 1. Right? This is nothing but an application of geometric return. Compounded annual growth rates are geometric returns. And what you will notice, the answer is equal to 6.2%. This means if you bought the bond at issue date and if you hold the bond till maturity, we always say that the return that you will get if you hold the bond till maturity is yield to maturity, YTM. So this is a simple proof that when you were issued a bond, you were told the YTM is 6.2%, which means if you buy the bond today and if you hold the bond till maturity, you will get a return of 6.2%. And this is how that 6.2% gets calculated. It simply proves the point that return till maturity is 6.2%. Now, what happens if interest rates decline after purchase? As soon as you buy the bond, interest rates fall from 6.2 to 5.2%. And when we say interest rate falls, we are looking at simply we say YTM falls, right? I think the word may confuse at times. Whenever you talk interest rates, it's YTM. If someone says coupon rate, that is a different number. Never confuse coupon rate with interest rate. I know in normal talking parlance, we do say coupon is equal to the interest that you get. But coupon rate and interest rate words will be used differently. Interest rate generally relates to YTM. So if your yields in the market fall, and we have already read this, that if yields fall, right? Sorry, this is the yields. If yield to maturity falls, the price of the bond will increase. It's an inverse relationship. So then what will happen is your price of the bond will increase and your coupon investment income will be lower because now you will have to invest at a lower rate, right? And the simple way to prove that is, again, if I say this falls to 5.2%, you see what happens to your reinvestment income. Your reinvestment income goes down from $20 to $16.71. Perfect. And your bond price obviously increases. So if I say, yes, you have invested $100 in this bond, okay, and you are going to get coupons worth $62. You are going to get principal redemption at $100, and you are going to get a reinvestment income of $20.49. In aggregate, this is your total inflow, 182. This is your total outflow. Therefore, the return on this bond is equal to this divided by this, 1.8249 raised to the power 1 by 10 on your calculators minus 1, 6.2% YTM. And that is the simple math that we were trying to run on the slides. Clear? Questions? Perfect. So always understand this. They work in opposite directions. When we say opposite direction, if YTM falls, price will increase, but your reinvestment income will fall. And if YTM increases, price will decrease, but your reinvestment income will increase. So they always work in opposite direction. And if you are ever confused, I always say prove it using mathematics. Don't worry about math, the relationships. Always try and ensure and have a confidence that, okay, you know what, if required, I can prove it using mathematics from my perspective, right? So I think mathematics could be your, major friend in this category, that you can prove things using mathematics to that extent. Okay, perfect. Then an investor purchases a new 10-year 6.2% annual coupon bond, and we'll prove this now. Rates immediately decline after purchase to 5.2%. Let's do a quick math. Give me a quick math. What do you think will be the return here? The final return. Use your calculators, do a quick math. I think the only thing that is going to change, obviously, you have to factor that in. Let's give this a try. Let's see what your numbers are. Let me run my numbers as well quickly. I'll just run it parallelly. First, will there be any change to coupon and principal payments? Will there be any change to coupon and principal payments? Anything on the coupon and principal payments? Right. I don't think there should be any change. Correct?
No change.
No change. Perfect. 6.2%, which means $6.2 into 10, 62 plus $100. Why are we taking $100 again and again? We are assuming you are going to hold the bond till maturity. We are not selling it before maturity. If we are going to sell it before maturity, we'll have to look at the number at which we sell. But we are saying we are going to hold the bond till maturity, which means 162 remains the same. What is going to change for you, obviously, is reinvestment income. As we saw on the Excel sheet, if YTM is going to decrease, then my reinvestment income will also decrease. And if you want to set it on your calculator, we will say N equal to 10, PMT equal to 6.2, present value 0, I by Y. What should be the I by Y? What should be the I by Y?
8.2.
5.2. Because the yields have reduced after you have purchased. Right? So that is one number that you will have to change. The yields have reduced, the interest rates have reduced after you have purchased. And this should give you your reinvestment income, or rather the future value from which we will subtract to get reinvestment income. So if I plug this into calculators, and if you have your calculators available in front of you, I think the only thing that changes for me is YTM 5.2. That is the only number I should change. Reuse your calculators. If all other numbers are already in the cells, please, there's no use of re-entering them. You can give it a shot again. It doesn't take a lot of time. But if you can reuse, I think that would help. And then you compute your future value, 78.71. So your future value turns out to be $78.71, which means your reinvestment income is $78.71 minus $62. And this is where you are going to say, okay, $16.71 is my reinvestment income. How much is your total return then? Calculate your returns. How much is the return on this instrument? I think the change worth highlighting is this. From our prior calculation to this calculation, what has just changed is YTM. And anything if bothers you around this calculation, please let me know. These are easy calculations. As I always say in CFA, there are certain concepts which will be inherently a bit difficult, right? You can give them a one read, two read, three reads. You will still find some issues until and unless you don't start working on it, right? On the job training, as we said. But these are concepts which are very easy. These are concepts which I think you should be able to crack in the class or maybe one more reading, and you should be just, set rolling with this. How much should be the return on this? And anyone if needs help on what we have done, please let me know. Well, if you remember, the return we said is the amount of money you collect. So your total is 162 plus 16.71. This is your amount in your hand divided by your investment of 100 raised to the power 1 by 10 minus 1. And this is your return on this instrument. So if I'm going to simply put it through my calculators or through my Excel sheets, I'm going to say my reinvestment income goes to 5.2%. This turns out to be $16.71 or $72. And if I'm going to say this 162 plus 16.7172, I have 178 divided by 100 raised to the power 1 by 10 minus 1. That's a 5.98% return, to be accurate to decimals here. On calculators, you can simply do 1.781, right? Which is basically 178.71 divided by $100. So we are going to simply take these two numbers. And on calculators, we have just divided the two numbers. And this, you can use this y to the power x, right? If you want, you can use this, or you can do a root of 10, right? Raised to the power 1 by 10 is nothing but a root of 10, square root, or rather not square, but a root of 10, right? So you can simply say this raised to the power 1 divided by 10. That is 1.06 minus 1 is this, multiplied by 100, if you want to look at it in percentage terms, is this. Why are we getting a 5.94? Because I'm just taking, 1.781, right? If I take exact numbers, I should get an exact answer. Perfect. So either ways, whichever way you would love to do it, calculators or Excel. Obviously, Excel you won't get in the exam, but calculators, I think you should be able to get the answer to 5.9899%. $16.71 of reinvestment income as we calculated, followed by a return of 5.989%. Remember, you have a lower holding period return here. HPR is holding period return. You have a lower holding period return as coupons were not able to be reinvested at 6.2%. You had to reinvest them at 5.2%, which is your reinvestment risk, but no price risk here as you are holding the bond till maturity. Therefore, even if if the price yields decrease, increase, you will still get $100. So there's no price risk. So in an instrument, there is always a price risk or reinvestment risk, right? If you scroll back a couple of slides, you will notice whenever you're looking at interest rates, it has two types of risk: reinvestment risk and price risk. You will face one type of risk forever. right? If you're going to sell it before. Clear? Questions? Okay. This one you should try. 4-year bond. I think that is, now we are holding it for 4 years. We are not going to hold it till maturity. That is the change. We are holding the bond for 4 years. So that is the difference here. Give it a try. I'll give you 5 minutes to give this a try. You're obviously holding the bond only for 4 years. How should the numbers shape up? I'll just get a glass of water for myself. In the meanwhile, you solve this. Yep. So how much should be the coupon and principal payments?
What is the meaning of par $100, sir?
What is the
Meaning of par.
par? Par means face value.
Okay, sir.
Par means the face value of the bond.
Okay, sir.
So step 1, you should tell me how much is your coupon and principal payments here. If you are going to sell the bond after 4 years. Okay, how many coupons will you get? How many coupon payments will you get?
4.
4 coupon payments. Perfect. So step 1, you are going to say that I'm going to get 4 coupon payments here. So that is $6.2 into 4. That is my
24%.
first payments. Plus, what are you going to get if you hold the bond till maturity? $100. But you are not holding it till maturity. You are selling it before maturity. So when I say principal payments, we are saying we are not going to get $100, but I'm going to sell it before maturity, which means I'm going to get $95.263 because I am selling it after 4 years. So this is one fundamental change in our approach, that I'm going to get
How are
X.
calculating 95.23?
They are just estimating a price that if we sell it after 4 years, that should be sold for, let's say, $95. Okay. So this becomes your number to sell the bond after 4 years. If the math is right, let me just check if the math works perfectly fine. You can actually calculate $95. So the way the math works is N I by Y on your calculator, PMT on your calculator, FV on your calculator and PV. So N of the bond is 10 years, correct? So if you're going to sell it after 4 years, someone will buy it for 6 years, right? Sell after 4 years, time left for the new buyer is 6 years. Okay, so I'm going to put N equal to 6, and that will help us understand if the price is right or has it been taken randomly while preparing this deck. I by Y, we assume will remain interest rates immediately rose to 7.2% after purchase. So I by Y 7.2%. PMT $6.2 because that amount is fixed. Face value $100, that is also fixed. So if I want to calculate present value at this rate, and on your calculators, obviously you should put this number and see, number of years at 6, PMT 6.2 and face value this 95.263. Perfect. So I think the number is correct on the slides. This is how you're going to calculate that $95.263. That after 4 years, if I have to sell, what will I get? The way to calculate this is first put in the number of years that will be left. Because if I am going to buy it from you, for me only 6 years are left. And other numbers are standard numbers. So $95.263 is what you are going to sell it, right? So we are going to say, okay, you got coupons, 4 years multiplied by $6.2. You were able to sell it, sale proceeds. So you got $95 by selling it. In total, you collected $122. And now, what was your reinvestment income? Calculate quickly. What is your reinvestment income? Based on this mathematics, what is your reinvestment income? You have to use the same calculator keys as we talked about. So this number turns out for us at 120 point, I think what was the number? $06. You're going to get 120.06. For reinvestment income, what should be your calculator keys? N. How much should be N? How much should be I by Y, PV, and PMT? So you're going to invest what amount? $6.2. How many years you're going to make that investment for? 4. At what rate? 7.2% because the yields rose to 7.2. The value in your hand today is 0. This collectively should give you future value. I have to put this on my calculator. Second clear TVM, 4N, $6.2 PMT, 7.2 I by Y, present value 0, compute future value. 27.61 should be your future value. And from this 27.61, you will have to subtract obviously your investments. So what was your investment? 4 multiplied by 6.2, 24.8. So 27.61 minus 24.8. So the way we are going to set this up, we are going to say this is 27.61 from future value of 27.61 minus 6.2 into $4 or 4 years actually. This should give me 24.8. So 27.6 minus 24.8 will be around $2.81. This is my reinvestment income. So in total, I'll get this and this.
Can you re-explain the calculation again?
Sure, ma'am. Which one did you miss out, ma'am?
Like why we are calculating 27.61?
Okay, so the point is you have invested $6.2 for 4 years, right? 6.2, 6.2, 6.2, 6.2. This will be invested for 3 years. This will be for 2 years. This will be for 1 year, and this will be for 0 year, because I will pay this to you after 1 year, which means you will be left with 3 years to invest because you're going to sell it after 4 years. So all this amount that you reinvest for different times will totally accumulate to 27.61. And from this 27.61, you are subtracting the amount that you invested to understand how much did you make additionally. The simple way to look at this is, again, I think Excel may help you here. See, you are going to invest $6.2, $6.2, $6.2 for 4 years, year 1, year 2, year 3, year 4. And we are saying you are investing this amount at a rate of 7.2%, right? You are saying this plus 7.2% raised to the power 3 years. Because if I give you after 1 year, you are left with only 3 years. Next, you are saying, Tarun, I'm going to get another $6.2 after 2 years, but I will have only 2 more years to invest because I will hit the 4-year timeline. Next, you will give me another $6.2, but I will have only 1 year to invest before I hit 4 year. And the last payment that you give me, Tarun, I will have no time to invest because you will give it to me end of 4 year. How will I invest it at all? So time is 0. In total, your investment will accumulate to 27.61. How much did you invest? 24.8. How much do you end up with? 27.6. This is like fixed deposits. Or you can call it the recurring deposit. Every month you invest some money and at maturity you get something else. The difference between the two is your income of $2.81. So this is what we are doing even on our math here. We are saying you are reinvesting 4 years at this rate, this amount. You will collect this. From this collected amount, you are subtracting your investment of 6.2 into 4, 1, 2, 3, 4. What you are getting in total is a $2.81 reinvestment income.
Okay.
Because for our return calculations, we will need these two numbers, 120 and 2.81. 120 and 2.81. And our returns therefore will be 120.06 plus 2.81 divided by $100 because we invested at $100 raised to the power obviously 1 by 4 minus 1 because I'm only holding it for 4 years. I'm not holding it for more than 4 years. So the solution for me therefore becomes very similar. When this plus this 120 plus 2.8, 122.8 divided by 100, 1.228 and raised to the power 1 by 4 minus 1. This is your return.
It's a compound CAGR.
It's a CAGR. It's a compounded annual growth rate. Absolutely. Or what your quantitative book will tell you, this is also nothing but a geometric return, geometric mean return, right? So you can call it a geometric mean return or you can call it a compounded annual growth rate. Absolutely right.
And the 1.228 is my uh, total overall return. Like
Overall
not
return.
the
Yes.
compounded, not compounded.
No, that is why it is written total return across 4 years. But we want what we refer as annual return, which is why we have to make this calculation to calculate our annual returns. In aggregate, you are basically getting 22.87% return, but that is over 4 years. So how much is your annual return is what we are trying to do this using a compounded annual growth rate number.
So it's not 1,228%. It's in the decimal format. Like we have to convert it into percent.
No,
1.228.
you can do that. Yes, if I do it like this, 1.22873. Think about this. You invested 100. How much are you getting? You are getting 122.873 in the numerator. So effectively, if you start at 100 and if you end at this, you know the returns are 122.873 minus 100 divided by 100. In percentage terms, 22%. Yes, you can convert it to percentage. So this is where we have changed a concept that you're not going to hold the bond till maturity. You're going to sell it in between. Maturity is not something that you're trying to play the game for, and that's absolutely fine. Not everyone holds the bond till maturity. People tend to sell the bond before maturity also. So in the first example that we did not assume a change in the YTM, right? The example one that you will revisit. In this, we said the YTM will remain the same, 6.2%, 6.2%, and you are not going to sell the bond before maturity. In example two, we said the rates decline to 5.2, which means your YTM is actually reduced to 5.2%. But again, you're going to hold the bond till maturity. In the third example, we said the rates actually increased to 7.2%. The interest rate increased. And if that is happening, you're also selling the bond early. So we have changed the scenario here. You're not holding the bond till maturity, or rather you are selling it early, and which is why your returns will be slightly different.
So like if we don't reinvest, then my uh, total return and across 4 years and annual return will be like same.
It will be if you don't reinvest, then
Yes.
again across 4 years, what you're going to do will be presented in 20%. But your annual return will always be adjusted accordingly, right? So if I do it on an Excel and let's say you don't reinvest, you tell me I'm not going to reinvest anything, which means what I'm going to get is $6.2 only. My reinvestment income is zero. Okay. So then what happens is I'm going to simply say no reinvestment income. 120 divided by 100 raised to the power 1 by 4. My return is 4.68%. The return falls annual. But yes, 4-year return will obviously be quoted like this. Your 4-year return is 20.06%. Okay. So it will never be the same. The only thing is your return will decrease because you're not getting any reinvestment income. If you have any reinvestment income, obviously that increases your return slightly. And again, you are absolutely right. It is not mandatory to reinvest. Fixed income assumes you're going to reinvest while proving the relationships. In reality, if I give you a coupon payment of $6.2, you can go and spend it. You can reinvest. You can reinvest at a different rate. Everything can happen. But our basic theory works on the premise that you're going to obviously reinvest the money back. Works? Questions? Okay. Actually, perfect. Then we move and dig into one of the fairly important topics on fixed income, the concepts of duration and convexity. And we are going to obviously carry this throughout the day today in terms of what is convexity, what is duration, and how does it help. Important line number one, duration and convexity. They are a measure of interest rate risk. How much risk does your bond face due to interest rate changes is measured by duration and convexity. So only duration is not enough. Only convexity is also not enough. in general, to measure your interest rate risk, you will have to use both the concepts, duration plus convexity. And duration again is of two types. You will have yield duration, different types of yield durations, and a curve duration. Convexity can again be of different types. You could have approximate convexity, and you could have effective convexity to that extent. Okay, like we have an approximate modified duration or a modified duration. This could be an approximate modified also, or you have an effective duration, you have a convexity and an effective convexity. And all of them have a mathematical construct to it. All of them can be calculated mathematically for our purposes. Let's talk about what each of these items is then. Now, what is duration? As I said, duration is the measure of sensitivity of the full price of the bond to changes in the bond's YTM or changes in rates. Break up the sentence. It is the measure of sensitivity of the price of the bond, full price or price of the bond, to changes in the bond's YTM or the interest rate benchmark. And which is why we say duration is a measure of interest rate risk. How much will the price of my bond fall if interest rates increase is what duration is trying to measure and quantify for you. This measure assumes that the variables other than YTM are held constant, which means out of N, TMT, FV, I by Y, and PV, we have 5 variables. We will assume this is constant, this is constant, this is constant. This is the only variable that is changing. And because this variable is changing, what is going to happen to our price of the bond is what we are trying to assess. So the assumption is all other are held constant. We are not going to change any other variable while doing this analysis. And now, because duration is a measure of risk of interest rate, it measures the sensitivity of the bond price with respect to bonds YTM. That same line. The statistics which measures this type of duration include Macaulay, modified, money, or PVBP, price value of basis point. And we have to cover each of them, right? One by one, we'll learn how to calculate each of this duration. First, Macaulay duration. This measure calculates the weighted average time taken to receive the bond's promised or cash flows related payments, right? So the idea is we are trying to understand how much payments can be received on a weighted average basis. And I think the math should help you understand how a Macaulay duration is calculated. Simple words, weighted average number of years an investor must maintain a position in a bond until the present value of the bond cash flow equals the amount paid for the bond. The other hand, curve duration measures price of the bond with respect to the benchmark yield. Now, why is this used? There are two, yield and curve. Yield is used for simple bonds. Curve is used for embedded option bonds. If you remember last time we talked about embedded options, puttable bond, callable bond. So if you have a puttable bond, if you have a callable bond, if you have a convertible bond, you are going to use curve duration, which is nothing but an effective duration. This measures with respect to benchmark yield curve, while this measures with respect to bonds own YTM. That is the difference. Yield measure based on yield to maturity. Curve duration is based on benchmark yield curve, like a government yield curve or a spot curve or a forward curve. The reason bonds with embedded options may not mature over a period of time they maybe have a premature withdrawal. Like I can retire the bond before time. So if I retire the bond before time, if there is a premature withdrawal, then in that premature withdrawal category, you may not have a YTM, because YTM is yield to maturity. And if you don't have a yield to maturity, how will you use a yield duration? Because yield duration is entirely based on yield to maturity, right? So the idea here entirely is you want to look at a curve duration if you're trying to model this. Let's give it a try. An investor intends to hold a bond with 8 years remaining to maturity. For obviously, if it is 8 years remaining to maturity and you want to hold it till maturity for 8 years, the bond's Macaulay duration is 6.841. The investor is primarily exposed to which of the following interest rate risk? If you remember, interest rate risk a few minutes back, we said is two types of risk. There is a price risk and there is a reinvestment risk, all the math that we did. So if the duration is 6.841 and if the maturity is 8 years, what type of risk are you exposed to if you tend to hold the bond till maturity? Which means you're going to say, I'm going to hold the bond till 8 years. If you're going to do this, you are exposed to reinvestment risk, because longer the time frame, your reinvestment value will keep reducing. Interest rate risk means if interest rates reduce, your reinvestment risk will be higher. And if you hold it beyond your duration time frame, there is always a reinvestment risk that you are trying to position. Let's revisit this in a minute. Let us try and understand step one. How do you calculate a Macaulay duration, right? We just talked about Macaulay, that Macaulay duration measures how much is your interest rate risk to your bond price. So let's give you a context how that 6.841 comes and then revisit the question. So if you have to calculate a Macaulay duration, it's a weighted average duration. As I said, Macaulay duration is nothing but a weighted average duration of cash flows. It's a very simple calculation. Example. Step one, calculate the cash flow for a bond at each time period. Find the present value of the cash flow. Find the weight of that cash flow. And then multiply the weight by the time, you will get your Macaulay duration. Let's do an example. Key terms, 5-year bond, 6.2% coupon rate, annual, par value $100, trading at par, so YTM is also 6.2. So let me just put the numbers here for you. Now, step by step, I'll explain each step to you here to calculate a Macaulay duration. Step one, write the time periods: 1 year, 2 year, 3 year, 4 year, 5 year. It is a 5-year bond. That is your step one. Step two, write your cash flows. By now, you should know you'll get coupon payments. And at maturity, you are going to get $6.2 of coupon plus $100 of redemption value, maturity payment. Then we will calculate present value of cash flows. How will we do this? We will take the $6.2 number and we will divide it by YTM of 6.2% for 1 year. We will take the $6.2 number and we will divide it by the YTM of 6.2% for 2 years to get to this. Like this divided by 1 plus 6.2% YTM. Remember, the denominator is YTM raised to the power 1 to get to this number. Similarly, raised to the power 3, 4, and 5. And you are going to get these present value of cash flows. The present value of cash flows are nothing but cash flow divided by 1 plus YTM raised to the power n. This is my present value of cash flows. Once you have your present value of cash flows, weight of these cash flows. How do you get to the weight? Take your number $5.84 divided by the total here. The total of all this is $100. So your first weight is 5.84%. Take your another number, which is $5.5, and divide your $5.5 by $100. You will get 5.5% weightage. So on and so forth. You keep dividing by the total of these cash flows, total of your present value of cash flows. So this gives you your weightage on each of the 4 securities, or each of the 4 or 5 cash flows that you're looking at. And then multiply your weight with time. So your weights, this column multiplied by the time, and you will get your weighted average time here. You add all of them, and what you get is your Macaulay's duration, which is expressed in years. Macaulay's duration is typically expressed in years. So although the bond is a 5-year bond, the Macaulay duration here is 4.45 years. It's a 5-year bond, but the Macaulay duration is 4.45 years. What does that mean? That means at a 4.45-year time period, on a weighted average basis, you are going to get your money back. All the investments you have made, the $100 that you have invested in this bond, you are going to recover your money in $4.45, 4.45 years. The remaining time, which is 5-year minus 4.45, the remaining time is the time to make returns on the investment. In that time, you will get return. This 4.45 year is sort of payback time. You will get your money back. It's a payback time. And this is called as Macaulay's duration. You will get your payback,
The payback means the principal amount.
principal amount back. So look at the interpretation. The math, as I said, is very easy. Once you know what a Macaulay duration math looks like, it is not a problem. Interpretation. What does this mean? If this is your investment horizon, let's say of 5 years, and your Macaulay duration is somewhere here 4.45 years, how does your risk play out? If your horizon is greater than 4.45, which means I will hold the bond for more than 4.45 years. Okay, then what is going to happen? Your reinvestment risk will dominate price risk. How does that work? If interest rates rise after you invest, if the interest rates rise,
But that means the YTM rises.
YTM rises. If the YTM rises, your holding period return will increase because your reinvestment return income will increase. However, if interest rates fall, your holding period return will decrease, which means if you hold the bond greater than duration, then you are looking at reinvestment risk dominating price risk. Reinvestment risk is greater than price risk. It dominates. Dominates means it will be greater than the price risk. Vis-a-vis, if you hold it less than the duration, your price risk will dominate. Now the risk can be return also, which means if interest rates rise, your price risk will dominate. That means your overall returns will decrease because your price risk is heavier. It will pull you down. While if interest rates fall, your overall return will increase. Now, how do you use this? You know the bond is 5-year bond, your duration is 4.45. What should you think about? You should always think what is going to happen with interest rates. In practical market, what do you think is happening with interest rates? Are interest rates going to increase or decrease from where we are today? If you think interest rates are going to increase, you would like to hold the bond beyond your duration. Because if interest rates are increasing, your return will increase if you hold it beyond your duration. But if you think interest rates are going to decrease, then you should sell it before the duration. Then your returns will increase, HPR will increase, holding period return will increase. And you can prove all of this mathematically, as I said. The three examples that we did, you can just set them up on an Excel sheet and just try and play around with the numbers to understand, okay, how does my risk work around? So this is how we use duration to understand, do I need to hold the bond beyond that time? Do I need to sell it before? The decision will be dependent on interest rates, because duration is a measure of interest rate risk. So your first question will be, what is going to happen with interest rates? Higher, lower? And accordingly, you decide, do I need to hold it, less than my duration or more than my duration time frame? And this is how you use Macaulay duration or any other duration measure to assess which of the risk is higher and how does it play for me in terms of my return parameters, price risk or reinvestment risk. And remember, both of them combined, price and reinvestment risk, is your interest rate risk. Bonds are only sensitive to interest rates. Bonds and interest rates go together. So if you're going to invest in bond markets, interest rate is your biggest variable to that extent. By now, I think some of us should have already understood that. So what exam can test you is on calculation. Macaulay's duration calculation can come. Unfortunately, calculator cannot do this using some set of keys. You will have to obviously do the long mathematical exercise, but it is easy and there's a guarantee that some of us will get this right. They can ask you basic theory that, okay, duration is a measure of interest rate risk, which means it helps us assess that if the interest rates are increasing or decreasing, what is going to happen to the bond prices. So this is also an assessment that can happen. And the exam can also ask us which duration to be used. All these yield durations are used for plain vanilla bonds which have no options, simple bonds. Curve duration or effective duration, as we said, is used for embedded option bonds, convertible bonds, putable bonds, or callable bonds. Three types of bonds which are embedded option bonds. I'm sorry. And similarly, approximate convexity used for plain bonds, effective convexity used for embedded option bonds.
So, like, we have numericals on all the types of duration or just the concepts?
All the types of durations you have numericals on.
Okay. So,
Okay,
can you switch to the Macaulay's interpretation slide once?
sure.
So, like, if our interest YTM is rising, then
Mhm.
our price will decrease. That means our selling price will will be less.
Yes,
So there is also a risk because I have to sell at a less per amount the bond.
correct.
So then how will my HPR is increasing in that case?
Because if interest rates are rising, your reinvestment income will rise. Your reinvestment income rises with it. Let's do that math for you quickly here. So let's say, uh, yep, I think let's just look at this and let me just model it for you to explain this point to you. Let's say you are in a bond which is a 5-year bond, 6.2% YTM, 6.2% coupon. Obviously, the bond trades at a par value. Okay. And now what is happening is the interest rates rise, right? The interest rates go from a 4-year, 3-year, sorry. Let's say the interest rate goes from 6.2%, where it was trading at $100, interest rate go to 7.2%. It goes to $95. So let's say, what is my reinvestment income? Also, let's model that. Let's just do a 3-year bond, quick and fast. 6.2. I can actually use this using calculator also, right? So this is my price for reinvestment income, 3 years of reinvestment, 6.2% reinvestment, $6.2, present value at 0. Let me calculate future value like we do it on calculator. This, I'm going to reinvest $6.2, present value is 0. So my reinvestment income is 19.718. Okay, and this is the price at which I am going to buy the bond. So what is my return? My investment that I've done is $100. What is the amount that I'm going to get back? So total cash inflow, if I'm going to sell this bond, obviously $6.2 into 3 plus $100 at redemption plus reinvestment income. My reinvestment income is this amount minus 6.2 into 3, like we did on the first 3 examples. This is my reinvestment income. So this plus this. Okay. Okay. Now my return. This divided by this raised to the power 1 by 3 minus 1. This is our basic case. You buy the bond today, hold the bond till maturity. After maturity, your return is 6.2%. Now let's assume we are going to sell it after 2 years or after 1 year. If I sell it after 1 year, how does my math look? I'm going to say someone is going to buy it for 2 years, right? And if someone is going to buy it for 2 years, assuming everything else remains the same, for this person, fair value, present value of the bond after 2 years, and the yields increase to 7.2%. This person is going to pay me $98 if I sell it after 1 year. So now I am not going to get $100. I'm going to get $6.2 for 1 year plus 98 plus a reinvestment income. I'm going to sell it after 1 year. So I hold it only for 1 year at a 7.2%. There is no reinvestment income because I got one payment and I sold it. I did not get time to reinvest. So I end up with $104 in my pocket on an investment of $100 raised to the power. Obviously, I've held it only for 1 year. My return is 4.4%. So as soon as your interest rate risk goes up or your interest rate rises, see what happens. You are actually making $104 after selling it, and you are exiting before your duration gets over. If you hold it even long, your price will keep falling. And if the price keeps falling, your return will keep decreasing, which is why the slide says that if you believe interest rates are going to go higher, do not wait for your duration time frame. Sell it before the duration. And the earlier you sell, the better will be your holding period return in this case, because your reinvestment income will be larger in that category. It will help you offset most of your problem. If you keep holding it, the curve tells you that the value of the bond will keep reducing as you move forward. So if you want, you can mathematically put around the numbers and try and prove this parameter that holding it beyond a period of time may not be disadvantage in certain circumstances, and in some circumstances it helps. Perfect. Questions? I think we'll also try and learn all other calculations like modified price value of basis point and durations. Math is easy. As I said, on duration, the math is easy. At times, the problem is uh, if you've never worked in bond market, you tend to miss out on the concept. Okay, what this is actually trying to tell me. But in general, level one will focus a lot on assessing the math. And did you understand what duration is as a measure of? It's a measure of interest rate risk. To resume our discussion around fixed income, so we move towards calculation of other, duration measures, right? In terms of the bond market perspective, apart from Macaulay's duration, what are the other duration measures that we are trying to model here? So to start off with, I think the idea is to calculate Macaulay's duration. Obviously, we have already discussed Macaulay's duration. It's nothing but a weighted average cash flow duration. What you see on the slide may look a lot more confusing than the tabular structure that we have talked about. That Macaulay's is nothing but more of a cash flow based duration, right? So take cash flows, calculate them over a period of time, and then perhaps run it through a Macaulay duration set up to that extent. So I think that is generally more easier to do than looking at this formula per se. Now in this case, if you're looking at it, this is a 10-year bond, right? And if you don't want to do the entire tabular format, you have to remember this formula, which personally speaking is relatively difficult. I would still prefer doing the tabular structure and solving for this. If you can remember the formula, I think that can help, but I don't know how would you do that. I have no recommendations around remembering this formula. This is inherently a bit difficult to that extent. So in this category, I would still say the tabular structure works best. Write down the time, note down the cash flows, do a present value of cash flows, weights, and then weighted average cash flow. The duration works for you. However, the next one on this category is modified duration. Now, modified duration can be done purely using a formula. So, modified duration is simply Macaulay's duration divided by 1 plus YTM. So, if you have a Macaulay's duration of 4.45 years, divide this by a YTM of whatever the YTM was, I think 6%, 7%, I don't remember, and that gives you your modified duration. What is the benefit of having a modified duration? Well, modified duration helps you assess the percentage change in price of a bond for a change in YTM. So I think the important element is this. Modified duration provides an important estimate which shows percentage change in the price of the bond for a given change in its yield to maturity. So if I say YTM has reduced by 1%, how much price of the bond is reduced? If you're trying to estimate that, modified duration can help you. The simple way to do this is if modified duration is, let's say, 6.3432, right? For a bond which has a Macaulay duration of 7%, 7 years and 10.4% YTM. So we have taken 7 divided by 1 plus YTM. This can be then plugged into a formula which helps you estimate the change in the price of the bond. So change in price of the bond can be given by minus modified duration into yield, right? So if I say minus modified duration into yield, I can provide you an estimate in terms of how much will the price of the bond increase or decrease. Simple example, note this minus sign in front of it. This means that the price and YTM are inverse. So if I say that the YTM goes down by 1%, then the price will be minus of 6.3432, which is my modified duration, multiplied by minus 1%. And minus will make it a plus. So if the YTM decreases by minus 1%, the price will increase by some factor, which is this minus 6.6342 into minus 1%. That is minus modified duration into yield is typically what we are trying to calculate. In this category also, largely understanding in terms of how the duration works. The next thing that comes up for us is approximate modified. Now, always remember when we say Macaulay is a cash flow duration. Modified is a duration that helps you estimate the change in price of the bond. right? Like this example on your screen. If YTM of a bond with modified duration of this changes from 5 to 6%, which means the YTM increased by 1%, then minus your modified duration of 6.12 multiplied by 1% tells you that the bond price can fall by 0.6% to that extent. Okay, 0.6% to an extent, the price of the bond can fall in this category. So this helps you understand, okay, yes, the bond price and the duration are inversely related to each other. So this is a simple application of modified duration, what we studied. Now, from Macaulay's to modified, the advantage is Macaulay's only gives you cash flow, while modified tells you how much will the price of the bond change. For us, it's always important to assess how much will price of the bond change. Approximate modified also does the same thing. The only difference is approximate modified is not based on Macaulay's. So you don't have to calculate Macaulay's. You can straight away calculate an approximate modified. It saves effort in calculating the Macaulay duration. You can straight away work with an approximate modified duration. What are the notations? What do you mean by PV minus, PV plus? So PV minus means value of bond if YTM decreases. PV plus value of bond if YTM increases. PV0, the base value. No change in YTM, which means base value. And obviously delta yield means the change in your YTM number. So the benefit of approximate modified duration is you don't have to calculate Macaulay's. You can straight away use an approximate modified and calculate or assess the change in the price of a bond. Simple example. First, look at what your bond data is given to you. If the price increase when interest rates go down by 5 basis point, right? Basis point means point. If I say 50 basis point, that is 0.5%. So when I say 5 basis point, that's 0.05%, right? So always remember, if I say 0.5%, that is 50 basis point. If I say 1%, that is 100 basis point. So you can basically do the math accordingly, that 0.5% is 50, 1/4% is 25 basis point. So if I say 5 basis point, that's 0.05%. 1 basis point is basically 0.01%. So the yield is going down and yield is going up by 5 basis point, which means delta yield will be 5 basis point. The price of the bond today is 80 P0. If the rates go down, the price goes up to 81, which is PV minus. And if the rates go up, price goes down to 79. So PV minus minus PV plus divided by 2 into delta yield into P0. Duration is 15.368. The benefit, you don't have to calculate Macaulay's. You can straight away calculate approximate modified, and then you can use it in your calculations to change the assess the price of the bond, right? The price of the bond assessment still remains the same. Change in price can be written as minus approximate modified duration multiplied by change in YTM. So if your duration is 15.368, you can simply say minus 15.368 multiplied by change in the price of the bond. Let's say minus 0.5%. So now you know that your bond price will go up by 7%. Clear? Fairly okay. So each duration has its own benefit. Macaulay's is simple. It tells you payback. Modified tells you how much will be the price of the bond changing. And approximate modified also does the same thing, but approximate modifies helps you to calculate the price of the bond without even calculating the Macaulay's duration. So you can straight away work with that parameter. All okay? Then comes money duration. What can money duration do for you? Money duration is annual modified duration multiplied by the full price of the bond. It doesn't multiply by change in yield. Money duration gives you the dollar change in price. Remember, the approximate modified, the modified were telling you how much percentage change in price will happen, right? So when we do this delta P, this is percentage change in price, right? If you see percentage change in the full value of the bond. But when you do money duration, the money word is a hint. This tells you how much will be the change in the price in terms of dollar value. Okay. This therefore, you're multiplying with the price of the bond itself. You're not multiplying it by the percentage change in YTM, right? So if you want, you can calculate money duration using a standard dollar-based number. That is, I think, advantage if you want to understand how much dollars will you win or how much dollars will you lose. Simple example, calculate the money duration of a 5-year semi-annual pay 3.2% bond issued at par value of 100. What will be the YTM in this case? What will be the YTM in this case? What will be the YTM? Remember, it's a 5-year semi-annual pay 3.2% bond issued at a par value of $100. Whenever a bond is issued at par value of 100, you've been given coupon. We've already said,
YTM is equal to coupon rate.
correct, YTM will always be equal to coupon rate, which will be 3.2%. So in this case, YTM is given to you, par value is given to you, face value obviously is 100, that we know, and price of the bond is also 100. Duration is given to you this, and the investor holds $1 million par value in the bond. How do we calculate money duration? Step 1, money duration is equal to annual modified duration multiplied by the price of the bond, right? So we are going to say this is equal to 4.58676 multiplied by $1 million bond, which I own. That is my par value of the bond. My bond par value is $1 million. So basically money duration turns out to be around $4.58 million. Remember, this is a dollar value. First, this is your dollar value. Now I need to understand how much will I lose or how much will I gain if the duration increases or if the rates increase or decrease. So let's say if rates increase by 1%, if interest rates goes up by 1%, how much will I lose? The simple answer is $4.58 million multiplied by 1%. And that is basically around $40,000, right? So we will say $4.58 million. Let me just quickly do it here. So our bond is 4.58. What was it? 676 into $1 million. This is your money duration in terms of dollar value. And if I say I'm going to see a rate increase of 1%, I'm going to lose $45,000 on my bond. That will be the fall in price on the bond. If I say this is going to be 2%, I'm going to lose $91,000 on my bond. If the rates go up, obviously, if the rates go down by 2%, I'm going to make $91,000 or $45,000 and so on and so forth. So step 1, when someone says money duration, this is the money duration, and then multiply the money duration by the rates going up or down to assess whether you will loss of $45,000 approximately or gain of $45,000 if rates decrease. So this is telling you how much will be your dollar income or dollar loss. It is not telling you percentage income or percentage loss. 4.586 into $1 million. and they are assuming it based on a 2% increase in yield, which means this number multiplied by 2%, this is the fall in price that we are looking at. It doesn't provide you negative numbers. That is something you will have to interpret and assess individually. But this is something I think we should be able to handle largely. Question?
So, like in practical world, we cannot follow all the methods of duration. Like we have to see which parameter is important for an investor according. Like it
So,
was like that.
no, so in practical environment, duration is something which is actually applied. So if some of you pick up bond mutual funds, and if you look at bond mutual funds, you will notice bond mutual funds publish duration as part of their data points. And the simple answer here is larger the duration, more is your interest rate risk. Okay, that is a straight relationship. So if you think interest rates are going higher, if that is what you think, then buy a mutual fund which has low duration, because then your risk will be lower. If you think interest rates are going lower, then buy a mutual fund with very high duration, because then your returns will be very high. So that is the way we assess. Now, which duration are we going to use to do all this? I've seen bond mutual funds using Macaulay duration. I've seen them using approximate modified, right? So everything to that extent is applicable. Yes, you need to ask the client, is he looking for a percentage change as an estimate, or is he happy if you give him a dollar value impact, so that he can assess, okay, what is my dollar? Sometimes the client tells you, I don't want to lose more than $10,000. I don't want to lose more than $50,000. And if the client says, I don't want to lose more than $50,000, you should know that based on a money duration that we are having on our screen, you should know that I can only play for 1%. If the yields change more than 1%, the client will lose more than $50,000, and that is what is not something the client would be happy about. So then you know that, okay, you have to keep a stop loss at 1%. If interest rates increase or decrease by 1%, you should be okay. But more than that, you have to just shut down the position, close the position, and exit. Sometimes the investor will be okay with even percentage returns. So yes, everything is practically possible, visible. It all depends on the investor's requirements in terms of how do you want to prepare a document to explain the investor all this. But yes, I think the gist of duration is this. It's a measure of interest rate risk. And if interest rates are going higher, buy low duration funds. If interests are going lower, buy high duration funds for better returns. And some of us should actually be aware about this, because a lot of us, when we open our account with debt mutual funds, or if you invest into a scheme like a national pension scheme in India, national pension scheme invests into government and corporate debt. So then we should know, okay, do I need to increase my exposure to bonds, or do I need to reduce my exposure to bonds over a period of time? So yes, money duration is going to do this for us. Now, in this category, what comes up also additionally is price value of a basis point, a PVBP. Price value of a basis point basically means what happens with 1 basis point change in yields. What happens with 1 basis point change in yields? So as I said, 100 basis point is 1%, 1 basis point is 0.01%. This means price value. What will be the impact on my price for just 1 basis point change in the yield, right? So price value is the movement in price for 1 basis point change in yield. Simple example, money duration into 0.01%. What will be the value loss if yields only change by 0.01%, or gain if yields change by 0.01%? Nothing new to do. You will have typically your money duration, like we said, and you just have to calculate a price value of basis point. You should know what is PVBP and what is 1 basis point. If you miss out on the definition of 1 basis point, then the question is not solvable at all. But if you know 1 basis point, I think the math is simple. if yields increase or decrease by 1 basis point, you will either make $458 or you will lose $458. And that is as simple as this gets in terms of calculations. It's just a 1 basis point impact, nothing more than that. So you can give the client this and you can tell the client, okay, I'm giving you 1 basis point mathematics. Whatever happens henceforth, you should be able to do your own math. If it becomes 2 basis point, 3 basis point, just multiply by 458 into that number and you will know what is your loss or gain on the instrument. Different ways of quoting the same thing from a fixed income perspective. Okay, now what impacts interest rate risk? Because we have been talking about interest rate risk at a stretch. Obviously, this is a risk that you face because interest rates in general can increase or decrease. Price of the bond can increase or decrease, and along with price, the reinvestment risk, right? We have repeatedly talked about this, and I'll repeat the equation again because it is important. Is nothing but reinvestment risk plus price risk. One of the parameter will get negatively impacted, the other will be positively impacted if rates increase or decrease. So what factors affect interest rate risk? And we did talk about this when we started talking about bond relationships last class. We said time to maturity, longer maturity, higher risk. Because I give you some money, you give me a bond, I know where you are in 7 days, but I don't know where you are in 7 years. My risk is higher. In 7 years, I'm looking at a higher risk. In 7 years, interest rates can go all over the place. In 7 days, I know there is no change to interest rates, and therefore my risk is lower. Coupon rates, lower the coupon, higher the interest rate risk because you are getting your money slowly. Your money is coming to you very, very slowly, and lower amount is coming to you. Higher amount coming to you, your risk is obviously lower to that extent. YTM, obviously lower YTM interest rate risk. So lower YTM will increase interest rate risk in its premise is primarily the one which we were talking about, investment horizon, right? It all depends what is your horizon versus your duration. That determines whether YTMs go lower or interest rates go lower or higher. How do you want to plan this out or play this out largely? So qualitative parameters, but I think focus a lot on the math part of it if you're trying to look at it from an exam perspective. A lot of people give up on fixed income because they are tired by the time you reach to a concept of duration and convexity. But again, these concepts are easy, right? The math is easy. The math is relatively comfortable to that extent, and you should be able to solve the math part of it. I think math gives you that assurity that, okay, you've got it right. Because on a theory part, you're always circumspect at times that, okay, am I getting it right, not right? What is happening on the theoretical aspect of the exam? Now, let's focus on convexity. We've talked a lot around duration, and when we started, we said, you cannot do everything using duration. Sometimes you will have to look at convexity also. Theoretically, understand the concept. The bond curve is convex in nature, right? Your curve is convex. Duration assumes the curve is linear. That is duration's assumption. So the duration assumes you are looking at linear curve. Therefore, duration is a linear measure. But in reality, your bond is a convex price yield curve. So convexity is to be included in your calculations. Otherwise, you will not be able to measure the change in price of the bond accurately.
So
So
by
the
linear,
true,
like what do you mean the duration?
so when I say linear, the meaning is duration believes that your price relationship is this, which means duration says if this is the price of the bond, let me just draw it at a larger scale. That would help. So let's just put it here on an Excel drawing for you. So what does duration do? Duration says this is your graph and I believe you are like this, which means if this is, sorry, if this is a line and this is the other line, this is your YTM this is your price. If YTM increase or decrease by same amount, duration says your price increase or price decrease will be same if YTM changes by same amount. That is duration's assumption, right? And if you draw this to accurate graph, I think you will notice the price changes similar. This side and this side, the length of the change will be similar. Okay, so price changes P1, P2 will be same for Y1, Y2, which is also the same, 0.5% on both sides. But in reality, the curve is convex. Now, because the curve is convex, and if we say the curve is convex, see what happens. If this is the base, and if I say you are going to increase or decrease by the same amount, and if I draw it to some accuracy, you optically will notice this part is smaller, while this part is larger. So duration says that we believe it is a linear graph, but in reality, it is not linear, it is convex, which means percentage change in price of the bond is not equal on both sides. If the yield goes from Y to Y1, price goes from P to P1. So percentage change in P1 from P is not equal to percentage change in P2 for Y2. Is never equal because it is convex in nature. And you can actually prove this mathematically also. I will just use this example of ours. And I think, did this last time also when we were discussing bonds, but I'll just do it again for you. So if you look at this, and you can do this on your calculators also. Okay, and if I say the yields are going to increase or decrease, let's say by the same amount, 1% decrease, 1% increase. This is P2, this is P1, this is P. The increase from P to P1 is 2.713%. But the decrease from P to P2 is 2.61%. This is proving the convex nature of the graph, that you can move on both sides 1% on the yield, but the price change will not be equal on the y-axis because the graph is convex. The graph is not linear. Yes, if the change is very small, let's say 0.1%, just 0.1%, then you will notice you do not understand the difference till you look at 3 decimals. On 2 decimal, 0.1% looks identical. On 0.5%, the 2 decimal itself tells you there is a problem. So the smaller the change, you will not be able to even understand the issue. 0.01%. 2 decimals don't tell you the problem. The 3 decimals don't tell you the problem. 4 decimals don't tell you the problem. By the time you hit the 5th decimal, you realize the change is not the same. What does this explain? This explains if the yields change very small changes or very smaller changes, duration can work. The error is very small. But if the duration, if the change in yield is large, duration will not give you accurate results because then the error will be larger. So this is why we say when we study concepts like duration assumes a linear relationship suitable to measure price for smaller changes in interest rates. But in reality, if there is a larger change, we will need convexity to help us understand and estimate a better change in price. Perfect. So this is where I think we will have to remember convexity is a improvement in our estimates. It helps us improve our estimates of price assessment. Now, how do you measure convexity for a single cash flow at a period? You can use this as a formula. However, more than convexity of a single cash flow, I think it is important that we are able to assess approximate convexity. Like we had an approximate duration, modified duration, we have an approximate convexity. And that approximate convexity takes very similar terms, PV minus, PV plus. We already talked about this. YTM reduces, value of the bond increases, that is PV minus. YTM increases, value of the bond decreases, that is PV plus. The minus and plus indicate YTM. Is YTM decreasing or is YTM increasing? Minus 2 times PV0, base value, divided by YTM square, change in YTM square into PV0. And where are you going to use approximate convexity? Once you understand the issue that, okay, this is what approximate convexity is all about. Where are you going to actually use approximate convexity? See our equation at the bottom. This was our earlier equation. Change in the price of the bond in our earlier equation was indicated like this, that change in price of the bond is basically minus annual modified duration into change in yield. But now we are improving our calculation and we are saying we are going to add half times annual convexity into YTM square. This is the second derivative because now we are looking at a convex relationship. It is not a linear relationship. It is not the equation of a line. It is the equation which is a polynomial equation. So mathematically, now we are going to add half into convexity into delta y square, change in yield square. And now what you're going to get is a better understanding in terms of how much will be the price of the bond that is going to change if your yields increase or decrease by delta yield, 0.5%, 1%, 0.25%, whatever that is. So this is the improvement on our equation. This is why we need convexity and approximate convexity. As we said, approximate convexity is useful for plain vanilla bonds. Bonds which do not have any embedded options. If there are embedded options, you cannot use approximate convexity. You will have to use effective convexity then, and we will learn how to calculate effective convexity and effective duration as well. If you're doing convexity of a zero coupon bond, you can use the formula stated on your screen. This can be done for a zero coupon bond as well, right? So if you want, you can use that and calculate a zero coupon bond convexity. That reminds me a very important element. The only bond, and I'm using that word very carefully, where duration is equal to maturity is zero coupon bond. That would be a simple question. Which bond amongst a set of bonds duration is equal to maturity? The only bond where this is going to hold valid is a zero coupon bond. So remember the equation, price of the change in bond. If both the numbers are given, duration and convexity, use this equation. If only duration is given, use half of the equation and solve for the change in price of the bond. Now, approximate convexity of a 3-year annual pay bond, 3.2% bond issued at par value 100. Calculate the change in price for a change in yield. Let's say 50 basis point change in yield, and plug the numbers into the formula to calculate convexity. Now, in this case, be very, very smart on the use of your calculator. See, N is equal to 3 payments, which are your coupons, $3.2 because it is an annual pay bond. I by Y, this is issued at par. So again, 3.2%. Face value, $100. Price of the bond, obviously issued at par, so $100. This is your P0 or V0. Yeah, let's just call it V0. This is your V0. Now you have to calculate V minus, V plus. Do not change everything on your calculator. N will be 3. Keep it as it is. Don't even touch the key. Payment will be 3.2. Don't touch that also. Nothing changes. Only this changes. It is saying 50 basis point, which means yield goes to, because of decrease in yield, this goes to 2.7 and this goes to 3.7. 0.5% added on and 0.5% subtracted. Lower yield, decrease in yield, increase in yield. And we know the change in yield is 50 basis points. Face value also not changing. Just compute your present value. This will be V minus, this will be V plus, and you then are done. You're going to say this formula should help you calculate your convexity numbers. So reusing the calculator is important at times. Why do you want to take the risk of, putting the numbers again, and then there is a possibility that an error just, percolates into your calculation. So it's always advisable reuse as much as possible from your perspective. Perfect. Questions? So if you plug this in, you will notice if the yields increase to 3.7%, price of the bond has reduced. If yields decrease to 2.7%, price of the bond has increased. Everything else is the same. N equal to 3, PMT equal to 3.2, FV equal to 100. The only change is I by Y, and present value obviously changes. This is your V plus. This is your V minus. V0 we already knew was $100. So V minus plus V plus minus 2 times V0, 0.5%, 0.5% square multiplied by V0. What you end up is an approximate convexity of 10.8. Questions? So just to reiterate, duration is a linear concept. Convexity factors in the convex nature of the graph. Therefore, duration plus convexity is your solution if you're trying to assess the change in the price of the bond. And therefore, what do we do with this convexity figure? As we said, we include it as part of our calculations to estimate the change in the price of the bond. The idea is we can improve our estimate. Earlier, there was a small error, which now gets rectified. Duration works great for small changes in yield. But if there are larger changes in yield, duration will need the help of convexity. Duration itself alone cannot handle this for us. So finding durations and convexity, I think you should give this a try. Whenever you find time back at home, I think you can note down the numbers if required. But you should give it a try and you should let me know tomorrow if you were able to solve this. If you wish, take a snap of this, note the numbers, give it a try. Modified duration formula was V minus V plus upon change in yield into V0. Perfect. So that is something into 2 times V0, sorry. So that was your approximate or your modified duration, largely approximate modified duration. And for convexity, we just saw V minus plus V plus minus 2 times V0 divided by change in YTM square multiplied by V0. Perfect. So do that if you're trying to solve it for approximate convexity. Sorry, multiplied by V0. 30-year bond is there, annual pay bond coupon is there, YTM is there. You can assume a par value of $100. So if you want, assume a par value of $100 and you know how much is the change in the yield. So everything is available to you. Take a note of this, try and solve, and let me know when you come back tomorrow what are your answers around this. We'll just skip on the calculation. I want you to do that. So in a nutshell, if you're going to do money duration, there is similarly a money convexity. I think it's easy to guess. Money duration was modified duration into price of the bond. Similarly, money convexity is convexity into price of the bond. It again helps you do pretty much the same thing. Helps you assess how much dollars are at risk or how much dollars will you gain if you try and price in some changes in the interest rates over a period of time. So you can leverage your duration learnings for convexity also. It's pretty much the same concept. Finally, all these durations go into a concept called portfolio duration. As I said, mutual funds. Mutual funds have a lot of bonds, right? They don't have 1 or 2 bonds in their portfolio. If it's a debt mutual fund, if it's a bond mutual fund, they will have 10, 20, 100 different bonds. So then they have a portfolio of bonds. And if there is a portfolio of bonds, you need to assess the portfolio duration. And when we are going to say a portfolio duration, we are going to largely say weighted average duration, which means weight of bond 1 in your portfolio, weight of bond 2 in your portfolio, weight of bond 3 in your portfolio, multiplied by the duration of each of them. Each bond will have a different duration. And then you add all these numbers to arrive at what is called as portfolio duration. So portfolio duration is weight of each investment multiplied by the duration associated with each of those investments. This is a quick example. An investor purchases 10 million par value bond, which is a euro bond, a 5-year zero coupon bond, and 10-year fixed rate semi-annual coupon bond. So there are 3 different types of bonds, or rather 10 million par value and these of 2 bonds. There are only 2 bonds, sorry. Each bond's data is here. 5-year maturity, 10-year maturity, coupon 0 because this is 0 coupon, pricing, YTM, duration, convexity. Based on rising inflation and tightening monetary policy. Obviously, if inflation is rising, economics should teach you tightening monetary policy, which means interest rates will be increased. Investor expects interest rates to rise. Given that view, which bond should the investor consider replacing the 10-year bond with? You're trying to assess which bond would you like to replace the 10-year bond with. Now, obviously, in this perspective, remember interest rates are increasing, right? And if interest rates are increasing, You have a 5-year zero coupon bond and you have a 10-year fixed rate semi-annual coupon bond. So if interest rates are going to go higher, which bond should the investor consider replacing the 10-year bond with? Think. So we have made a decision that we have to replace 10-year bond. This is the bond we have to replace. The features are 5.5% coupon, 4.75% YTM, duration, convexity, obviously high duration. That is why we are selecting 10-year bond. Higher duration is higher interest rate risk. Higher convexity is higher interest rate risk. This is therefore at higher risk. I want to replace this. Now I will replace this with a floating rate bond. Why with a floating rate bond? Because the benefit is if interest rates rise, obviously a floating rate bonds coupons will also rise. The coupons are floating, right? They are not fixed rate coupons. There are floating rate coupons. So the interest payments will also rise. And if interest payments rise, that covers a bit of my risk. That if bond price, if the interest rates are rising, I'm getting more interest payments, also more coupon payments also. So for me, that is a bond that I would like to replace it with a bond which offers me a higher coupon rate, which is a floating rate bond. Have low interest rate risk because coupon payments will also adjust to changing interest rates. You will have a higher coupon payment as well. Perfect. Questions? Anything that you have as questions today? And otherwise, I think we're good for the day. And tomorrow, I think we'll continue with the fifth part of fixed income. We'll cover additional elements in terms of the effective convexity, effective duration parameters, credit risk, and other elements associated with credit analysis. Nothing? Okay. All good then. Have a good Saturday. And apologies for scheduling this early today. And we will see you tomorrow at our regular time slot, 10 to 1, and we'll carry it from there. Thank you.